Good morning, I'm Guy Johnson. Joining me around the table this morning, Lizzy and Tom Mackenzie. We're an hour away from the opening trade. What do you need to know? Well, UK CPI inflation is hitting right now. We've got the data, we've got the analysis, and what it all means for Chancellor Rachel Reeves. The US December CPI inflation number hits at 7:30 Eastern. What will a hot number do to US 10-year yields? Are we heading towards 5%? And Bloomberg has learned that Washington is about to hit semi-stocks like TSMC, Samsung and Intel with fresh and wide-ranging regulations designed to stop advanced chips getting into China. Lizzy, we've got a number that is a little softer, actually, out of the UK than maybe the market was looking for.
We have indeed 2.5% on UK CPI. We'll get to that in a moment, Guy. It's also all eyes on the US CPI number today. But we saw the PPI number yesterday missing expectations and actually the kind of ripple effects into the bond market. But here is the reaction on cable. Weaker 0.1%, $1.22. Not a lot of movement, really. Just missing by an ever so slight margin on expectations when it comes to UK CPI. We've got futures pointing pretty flat at this moment, but the countdown to the opening trade starts right now.
Wednesday the 15th, good morning folks. Today is all about CPI. We've got CPI data out of the UK. That has just dropped onto our screens. Looks a little soft. Then we move on to what arguably could be the main event, and that is US CPI. That drops at 7:30 Eastern a little bit later on today. The market is on tenterhooks, waiting to see whether a hot number sends US 10s towards 5%. Lizzy, let's deal with what we know now. UK CPI, a little soft.
Yeah, misses on the headline core and services levels. So headline 2.5%, the expectation was 2.6%. Core 3.2%, the expectation was 3.4%. Services 4.4%, the expectation was 4.8%. So very welcome, actually, on all of this. And really the spotlight had been on it, of course, because of all the market turmoil that we've seen in the UK over the past week. The Bank of England had kind of seen bets being paired on cuts so far this year. Andrew Bailey had said that there would be 4 this year. Traders had only been seeing 1. Do we see a reversal of that at 7:30 when Bank of England bets open?
What I'm fascinated by is the lack of a reaction in sterling. You're not getting a big reaction here. Do we have to wait for the gilts to open a little bit later on to see that reaction? Or is this number, is the miss not big enough to actually really change the picture a great deal?
Well, what is driving the pound right now? Because it's certainly not higher yields, is it, in recent weeks and days? The higher yield story, higher pound story has broken down. So where is the next direction for the pound, given the softness that we've seen? 121 right now. Liz, you have views on this in terms of the direction for the pound?
Well, you asked me the question, what's next? Of course, we get the US CPI print, and then we get GDP as well from the UK tomorrow. That politically will be important because it will reveal more about this slowdown since Labour came into office in July.
Can I just flag something else as well, which I think is really interesting around the UK, and that is what the inflationary trajectory looks like from here. There's a BRC, British Retail Consortium, survey out this morning of CFOs and what they're going to be doing in terms of labour, in terms of what they're going to be doing in pricing. 2/3 of CFOs say they're going to pass on the costs that they've got as a result of the budget onto consumers. They're also going to be cutting labour, they're going to be cutting overtime. So this is quite a bleak report in terms of the outlook, A, for inflation, and B, the labour market, which points to your maybe stagflationary narrative when we get that GDP figure.
With a finger pointing very clearly at Chancellor Rachel Reeves for that rise in payroll tax announced in October to come in April.
OK, let's talk about what's going to be happening a little bit later on in the United States. This, folks, is going to be the main event. The number we've all been waiting for post-payrolls to see whether there's confirmation of the strength in the US data that we have been seeing. This CPI print, absolutely pivotal. The headline 0.4, the core 0.3 is what you're looking for. This would be the 5th month of gains. Basically, the implication is that deflation has stalled here. And Tom, this is before we even get to the Trump tariff story.
Absolutely, and how much of the front loading in terms of purchases as well, just in terms of imports, is a factor across the data when it comes to the US. This is a holiday season, of course. Inflation data is the December month, so there may be an impact there. There may be some seasonality, but Bloomberg Economics, again, expects it to be a pretty solid number. They certainly don't expect it to tie into any view that you're in a deflationary cycle for the US. They think it's going to undermine anyone who has that view. The core is seen holding at 3.3%, and on a month-by-month basis, headline, as you said, coming in at 0.4%. On the 6-month analysed basis, you are still above 2%. And that is the challenge for the Fed.
Yeah, look, the reaction to PPI, as I say, kind of showing in the bond market this bias towards higher yields. But really, is this CPI print today enough to answer the questions over inflation in 2025? You've got so much uncertainty, not least around Trump tariffs, but also LA and the fires and how that's going to feed into
It's going to impact rents, which is actually a factor that has been coming down recently. And you wonder whether that gives a boost back into that narrative as well. Rebuilding costs could be super expensive. That may also add in to some of this data over the next few months too. Do we get to 5% on a 10-year after today's numbers? We're not quite there yet. Does the March cut get taken off the table? Valerie and I were sort of chatting about this before we came on air, just trying to figure out exactly where we are. We're not that close to 5% yet, but we're not that far away either. So it's going to be an interesting day. The UK CPI is the warm-up act to the main event. Let's talk chips.
Yeah, and by the way, if you get to 5%, does that bring the buyers in anyway? How sustained would that grind higher above 5% be? On chips, so just another measure coming through. This is according to Bloomberg reporting from the Biden administration, of course, in their final few days. And this is around putting pressure on TSMC and Samsung, of course, the owners of these massive foundries, in terms of shipments to chips, not surprise, to China. This top line, it's very detailed, it's very complex if you put it on top of all the other restrictions. Top line is, this is about putting sand in the gears of these chip companies to make them stop and think before they sign off on purchases, to scrutinise the buyers. The US is concerned that some of these chips have been getting to companies like Huawei, which of course is blacklisted. This is about making these companies, these foundries outside of the US, put added scrutiny on their clients.
But Tom, you're the tech expert around the table. Does it really matter when these are old generation chips they're targeting?
Well, that is part of the point, because China has taken a lead in producing some of the quote-unquote legacy chips itself. You're right, this is targeting 14 and 16 nanometers, so not the most cutting edge part of the space. But what it's done, it's broadening the scope, because the most cutting-edge AI accelerators already heavily restricted, and now it's broadening that out. They're at 2-3 nanometers. Now they're broadening out all the way to 14, maybe 16.
Is this basically the Biden administration annoyed that the earlier regulations haven't worked? And we keep seeing these breakdowns of Chinese kit, and the chips keep showing up. You
can still find NVIDIA GPUs in markets, in tech markets in Shenzhen. You can go on the ground and find one of these. Not because NVIDIA is breaking the rules, but because suppliers in China are very sophisticated in terms of sourcing them from third parties. So, yes, absolutely, it's about closing those loopholes and, again, just making it much more difficult for China to get hold of a range now, a broad range of chips.
OK, that's the chip story. We're going to go back to the inflation story, back to the bond market story very shortly. Mark Dowding, CIO at RBC Bluebay Asset Management, is going to be joining us shortly. We'll talk stocks with Sharon Bell, Senior European Equity Strategist at Goldman Sachs. We're going to talk about the impact of higher yields with Chris Brett, Head of Capital Markets for Europe at CBRE. All of that coming up, Tom, in a packed day.
Yeah, and before the US inflation print, we're going to get some more data out of the euro area. Industrial production, that drops at 10 a.m. UK time. And then it is the big one, of course. 1:30 p.m. UK time, US CPI. We will be breaking that live for you, giving you all the context and analysis. And then later in the day, 7 p.m. UK time, the Fed Beige Book, so some more colour coming through in terms of that gauge on the health of the US economy. And later, Trump cabinet confirmation hearings continue. We had, of course, the nominee for the Secretary of State for Defense speaking yesterday. Today, Pam Bondi, Marco Rubio, Secretary of State nominee, of course, former Republican John Ratcliffe, and later we're going to get some Fed speak, as well as we continue to assess the next steps for the Fed, given the inflation data out late today. We're going to hear from Barkin, Kashkari, Williams, Goolsbee. All speak in the afternoon UK time, presumably after the inflation data. And later, it is the earnings story, kicking off with the banks, front and centre. Wells Fargo, JP Morgan, Citi, Goldman Sachs, BlackRock, all set to report trading, investment banking flows, to what extent the gains coming through. Goldman Sachs is up 51% over 12 months.
The run over the last year has been absolutely sensational for these stocks. I heard you talking to Charlie Wells earlier. The conversation now is whether or not all the good news is in the price. Trump deregulation, what is happening with the economy, is all of this in at this point? And therefore, well, everything seems to be priced to perfection at the moment. You do wonder whether there's a danger, therefore, that any kind of a miss, if the investment banking fees don't stack up, if the trading revenues, if there's a miss on trading, which obviously is where the volatility lies within some of these institutions, does that generate an outsized reaction given where the stock price is right now?
And we want to see if capital markets are coming back, if the deal flows are coming back. Yep. And are they seeing a bit of a sweet spot in terms of rates, which, yes, have come down but now seem to be on hold for longer? Is that a bit of a sweet spot for the banks in terms of net interest income? And if there is some softness there, to what extent is that offset by trading?
Lots of deposits as well, kind of. That's one of the factors as well, which will weigh on the numbers. OK, let's talk about some of the other big stories we're watching this morning. South Korean President Yoon Suk-yeol has become the country's first sitting leader to be arrested after the police launched a dramatic pre-dawn raid on his residence. The arrest comes after Yoon defied summonses to appear for questioning over his failed declaration of martial law late last year. Yoon will now be held for 48 hours before potentially being detained for up to 20 days beyond his initial arrest. Southern Californian residents, exhausted by weeks of wildfires, evacuations and blackouts, are tonight facing another fraught 24 hours. Returning Santa Ana winds are threatening to fan flames, with more than 10 million people facing what officials are calling a particularly dangerous situation. Estimates of insured losses continue to rise. Keefe Bruyette and Woods now estimates the figure could be as high as $40 billion. That's double the figure that it came out with just a day earlier. And France's Prime Minister François Bayrou says he's open to renegotiating President Macron's highly controversial 2023 pension reform in order to gain parliamentary support for his budget plans. Bayrou is proposing that Labour and business unions negotiate changes to the plan, including potentially halting anticipated increases in the minimum retirement age to 64. You think about what's happening in the UK right now, and you do wonder whether the spotlight ultimately gets turned on France as well. If they do roll back the pension reform, the only major achievement, you could argue, of Macron's second term, it's going to have impacts on the budget, the deficit and everything. And you look at the spotlight on the UK right now and you do wonder whether France is going to be next and how quickly that could happen. I
mean, it kind of makes the UK look strong that actually the government was able to at least pass a budget. But, you know, this olive branch offered by Bayrou, yes, it looks all right for now, but then in 3 months' time, you mention about whether the sums add up. If they can't make the sums add up, the political fallout will just reopen again with the socialists. So
the spread is 140 in terms of the UK 10-year versus the French OAT, and of course, you know, ECB and everything else, Eurozone. But I mean, is that justified? Bayrou has got some reprieve from the socialists, but for how long? Because working through this reform process seems to be incredibly complicated. Again, I mean, the labour unions and the employers coming together to come to some kind of agreement on 62, 65. That sounds high risk in terms of the weeks and months ahead. So there's some reprieve for now. For
socialists are basically saying, unless you say you're going to renegotiate, we're not on board. And that then puts censure back on the table, and that's the risk basically he's dealing with. He's having to at least tiptoe towards the idea that maybe some sort of negotiation can happen. The details are really sketchy at the moment in terms of how that's going to happen. Yeah,
we'll keep an eye on that oats bunch spread. Still twice where it was before Macron called the snap election last year. Very much in focus. But coming up on the programme, we're going to hear from the EU's climate commissioner on his plan to push the continent's competitiveness in the electrical vehicle space. We're also going to have the SEC story suing Elon Musk over his Twitter shared disclosures ahead of his takeover. We'll bring you the latest on that. But up next, inflation topping market concerns today on both sides of the pond. We'll break down the UK data and look ahead to US CPI next. If you've got any questions of your own for our guests, please do send them on IB Plus to BBTV Go. This is Bloomberg.
42 minutes to equity markets opening, 42 minutes until gilts open. Let's turn our attention to what is happening in the States later. Will today's CPI print reinforce the case for an extended pause in the Fed rate-cutting cycle? Headline consumer prices expected to accelerate year-on-year to 2.9%. Let's get the details, break it all down, and watch what we should be looking for in terms of the components. Valerie's here to do all of that.
Guy, the component that the market will have its most attention on is the core month-on-month reading, expected to come in at 0.3 for the 5th month running. And this is important, Guy, because a 0.3 reading takes us farther away from that Fed's 2% target. Any upside reading on that core print could tempt the market to believe that Fed hikes could be closer than the market expected. But that's the U.S. CPI picture. We did get the UK CPI out just a few moments ago. Big miss when it comes to services CPI. To take some pressure off the gilt market at the moment. We'll dive into details on what drove that big services miss. But the big takeaway, at least for the sterling market, is this is a move weaker in the pound. We had a bit of a tussle, tried to rally originally, maybe thinking that this fiscal headroom that the government has run into will get a little bit more headroom based on a gilt rally today. But we are to the downside when it comes to the cable currency. Many out there thinking that this soft print will reiterate the Bank of England's intention to cut 4 times this year after recent repricing put that into doubt.
Yeah, this ongoing liquidation we're seeing in sterling certainly seems to be maybe continuing now we've digested that print. Valerie, thank you very much indeed. Joining us now to talk about all of this, Mark Dowding, CIO at RBC Bluebay Asset Management. Morning.
Morning.
What's your reaction to the number?
So I think it's a good number, but this could be as good as it gets for the time being on UK inflation. I think the big issue, the big concern investors have is you look at council tax hikes this year, you're looking at utility hikes, you're looking at higher food prices. You've got the BRC yesterday saying that across the board people expect to pass on the costs of higher taxes through to retail prices. And looking at this, it just strikes us that we're in a world in the UK where inflation is likely to stay stuck around 3.5% to 4%. And if that's the case, we just don't really see much of a case for the Bank of England being able to ease monetary policy this year.
Does the move out of sterling just therefore continue? Does the move out of UK assets broadly just continue?
Yeah, so I think the UK is in a difficult spot right now. Effectively, we're an economy that's experiencing weak growth and also inflation that is above the central bank's target. From that point of view, we think it's going to be very difficult for the BOE to cut rates. It's going to be very difficult for the Chancellor to ease fiscal policy. If anything, Rachel Reeves is going to be under pressure to raise taxes or potentially cut spending in the spring. And so from that point of view, I think the worries around stagflation in the UK are a real theme this year. And when you think about this and when you think about what is the easiest thing to give here, I'd actually argue it's easier to let the currency go a bit than it is to actually force through tax rises or force through spending cuts. And so I think it's understandable that having seen investor positioning more to the long side in the pound through much of 2024, actually sterling is now being positioned more to the short side, and we think that there's more room for this move to run. We'd be looking for a move down to 110, 115 area over the course of the next month or two.
So, Mark, you're exactly the sort of person that the Chancellor needs to impress. I think you oversee $130 billion in fixed income assets. What does she need to say? What does she need to do to convince you to buy her government's debt?
So this is a tricky one. I think the reality is that Rachel Reeves inherited a fundamentally very weak position from the Conservative government. That said, the incoming administration haven't been making things better at the margin. They've been making things worse, haven't they? I think that what you really need to see is you need to get growth growing. And we've seen sort of a lot of rhetoric around this, but there's not really a lot of meat on the bone in terms of what's going to be done to actually empower growth, empower activity. And I think that understanding this, understanding how we're going to get growth growing is really what investors need to understand. Because when it comes to debt sustainability, you could sort of argue it's the debt to GDP equation we all fascinate over. Actually, UK debt levels aren't that high. It's the fact that we're looking at an economy that people are now saying structurally this is an economy that just doesn't grow. This is an economy that looks like it could be stagnating for quite a long period of time. It's a country where people are kind of giving up a bit.
I mean, I suppose she would say that, you know, they're trying to do deals with China, there's AI as well, but in the short term, given the eye on gilts, would it help if she specified which spending cuts she would like to make? We were talking to Rupert Harrison, of course, former economic advisor to Chancellor George Osborne. Take a listen to what he said.
The most likely option is that she will trim her spending envelope in the last few years of the forecast. And this is something that markets are now very used to UK governments doing. It would be probably outside of the 3-year window of the spending review that she's probably going to set. And therefore, it's just a stroke of a pen. It's just changing some numbers on a page. It's not real action. It's not very credible.
The reason I play that, the stroke of a pen, is because I wonder, does she need to cut spending in the near term, never mind long-term growth, to regain confidence of investors like you?
I think seeing some tangible action would certainly be appreciated. At the moment, a lot feels like hot air, doesn't it? You look at the amount of money that is being raised in a trip to China, it's kind of peanuts. For all the talk about AI, what's that really going to change in the near term? If anything, the deployment of AI could actually end up to fewer jobs being created, right? So this is a double-edged sword as well. So I think that when you're looking at the UK, you're saying what can be done to get growth going, what can be done to actually put the gilt position in a stronger footing. Here, I think my message to the Chancellor would be have a word with the DMO, stop issuing longer-dated gilts, tell the Bank of England to stop their sales of gilts in terms of the QT plan, maybe skew your issuance to the front end. But I think we need to understand that we're probably in a world that if inflation is 3.5 to 4, we're probably in a world where interest rates probably need to sit pretty much where they are. And if interest rates are at 4.75, actually having longer dated borrowing costs pretty much where they are today is probably where they should sit. We just need to understand that this is the economic reality that we're dealing with. I think the painful thing for Rachel Reeves and others is they have been discounting a declining yields, a declining borrowing cost this year to actually give them more money to go out and spend. And they're going to have to realise that they're not going to be as ambitious on their spending plans as they've wanted to be. And they're not going to be able to deploy the spending or actually transform public services until they can actually get the economy going. It's the economy that they need to focus on.
What is the longer-term risk premium, then, that we should be baking into gilts at this point? Where is the ceiling on yields?
So I think the ceiling on yields, I mean, I would like to think that yields won't go beyond 6. I don't think we're facing a convexity event as we were in 2022 in terms of the gilt market and LDI under the days of Liz Truss. That said, I think if you think that cash rates sit at 4.75, a long end at 6%, that would already price 125 into a curve. I think that would probably be enough. Relatively speaking. Obviously, some of this depends on what US Treasuries are doing at the same time. And part of the move up in gilts, we need to remember over the course of the past month or so, has been very much a factor that US yields have been moving higher. So this isn't just about the UK, albeit because of what happened in 2022. In a way, the UK is a bit of a canary in the coal mine when it comes to fiscal debt worries and fiscal debt concerns.
Why are you fading that bearish call on US Treasuries?
So in terms of US Treasuries, here I would argue that if you look at what is being priced in terms of the Fed this year, you're only now really pricing one rate cut in 2025. And we've still got a Fed which is far more inclined to cut interest rates than it is to raise interest rates. So we think that pricing at the front end of the curve is broadly fair at this particular moment. And so if you end up with 4.3 as the rate on the cash rates in the US, again, looking at the longer end of the curve, close to 5, again, we think is close to fair value. So having been really bearish on the outlook for Treasuries a couple of months ago, I'd argue today you're probably at a juncture where things are fairly priced. And given how uncertain the world is, you probably don't really need to express a view one way or the other.
In 10 seconds, Mark, do you buy OATs?
No, I don't. I think that France is a long-term concern. The message is, don't worry about the budget right now. It's the middle of the year. Bayreuth's gone then. It's all about the timing on Le Pen.
Mark, great to see you. Mark Dowding, there you go. CIO at RBC Bluebay Fixed Income. This is Bloomberg. We'll talk France next.
We must get together to adopt without delay the two budgets for the state and Social Security. We all pay a high price for this absence of budget. Businesses, investors, families, taxpayers, borrowers. The new government team carries a message, as in times when the fate of our nation is at stake, the general interest must prevail, and we must go beyond party divisions so that the country can pull itself together.
The French Prime Minister presenting his policy agenda to Parliament yesterday. In that speech, François Bayrou also offered to renegotiate controversial pension reforms, including plans to raise the retirement age to 64. Let's get more from Bloomberg's Caroline Connard in Paris. Caroline, François Bayrou, he talked about healing those divisions. Did he have any success? What were the highlights?
Clearly, he's reopened the Pandora box with this reopening of the negotiations on the pension reform. Remember, this 2023 pension reform was adopted after months of protests in the streets, and it was seen as the highlight of Emmanuel Macron's second mandate. Now it's kind of back to square one with the socialists actually saying this was the only way for them not to back a motion of no confidence against this new Prime Minister, François Bayrou, as soon as this week. So the socialists got their way, and François Bayrou also warned that the growth will be lower this year in France, so that also means less revenues for the state. He's lowered the growth target to 0.9% of GDP, in line with the Bank of France forecast, and he's also lowered the deficit target to just 5.4% of GDP. The target of his predecessor, Michel Barnier, was to bring it down to 5% of GDP. So clearly a less ambitious budget ahead. That would be the next test, this budget in mid-February.
Caroline, we've just been speaking to Mark Dowding, Bluebay, big investor in global bonds. He sees Bayrou gone within the next few months. He sees early elections coming through. How long can Bayrou kind of stave off that kind of a situation? Is what he has announced already going to buy him some time? How long can he survive for?
He is clearly trying to buy some time, and in fact the National Rally of Marine Le Pen has already said they will not back this motion of no confidence that's already presented by the far left this Thursday. And in fact Bayrou said something else in this speech to kind of get the support from the National Rally, is that he said he's ready to introduce a change in the voting system with some kind of proportional voting system, because currently, as you know, the two-round voting system in the legislative elections makes it more difficult for the smaller parties and for the National Rally to get lots of MPs in Parliament. So we'll see what happens. Clearly, he's just buying time because the budget discussions are going to be very tough. There's a poll he actually quoted in his speech at the beginning of his speech yesterday, saying that 84% of the French actually agree with his statement that he's not going to survive this year. And he actually used a sense of humor, saying himself, I actually wonder where the 16% remaining find their optimism.
OK, Bloomberg's Caroline Connard, we thank you for bringing us the latest on French politics. But I just want to bring it back to the UK now, because, of course, we did have those CPI numbers breaking at the top of the hour, missing on the headline core and services levels. You had seen the pound down about 0.4%, pairing those earlier losses now, just down about 0.2% at $1.21 now. But interesting to see the change of BOE bets. So these came in just a couple of minutes ago, and actually traders adding to BOE bets this year. 48 basis points of cuts now seen this year. Andrew Bailey in December had said that he'd seen 4 cuts this year, but that had then traders had only seen 1 fully priced, 1.5. So this is adding to the dovish sentiment in markets. I think the reason is particularly the services miss, because this is really what the Bank of England cares about. Mark Dowding is talking about the airfares contribution to that. But, you know, airfares notoriously changeable in December. And so do we actually see inflation go up again?
The survey period was higher. Basically, he says this is as good as it gets in terms of the inflation. So you wonder what the next print ultimately is going to look like. Does it ratchet significantly high? We've got the BRC survey today talking about prices being passed on, costs being passed on to consumers. The price cap, the energy price cap, is also increasing as well. That comes through, and that's going to be factored into the mix as well. Gas prices generally are rising. If this is as good as it gets, you wonder how quickly maybe some of that pricing could be reversed.
Pricing right now, 85% chance of a cut in February. So that is the market pricing right now with, as Lizzy was saying, a full 2 cuts now priced in, 50 basis points by the end of the year. Do they need to distinguish between the different types of inflation? This is not demand-led inflation that we're talking about in terms of council taxes and energy rises. Can the BOE distinguish because households and businesses are feeling the squeeze?
Wages are still reasonably elevated. They're not the prime driver, or they are not as much of a driver as they once were in terms of the narrative. But wage price elevation, the wage price story is still represented here, and that continues to be the concern, that you continue to see that being pushed through. Plus, also, the government is raising wages across the board for a lot of public sector workers at the moment. That is going to feed through as well, we would assume, into the economy as well.
Yeah, that BRC survey saying that food prices are going to rise 3.5% this year. 2.9% was the increase last year.
Yep.
Just seeing the reaction as well from the Chancellor Rachel Reeves to these UK CPI figures. She says there's still work to be done to help families across the country. Growth is our top priority, to put more money into the lives of the pockets of working people.
OK, let's move on and talk about what we're going to be focusing on next. The EU's top diplomat has told Bloomberg that she is pushing for the price cap on Russian oil to be lowered to deprive Moscow of war funding. Kaja Kallas also wants the bloc to look more closely at raising joint debt to bolster defence spending. She has been speaking to Bloomberg's Oliver Crook.
Oil price cap. I have been advocating for this when I was Prime Minister of Estonia, and I'm really pushing for this to be lowered because it has a clear effect. What we see on Russia's side, I mean, they are struggling because their national fund is depleted and they don't get the same revenues that they did from oil and gas. But there's still room that we can use, and definitely the countries need to discuss that. What comes to sanctions, then we are constantly working on new sanctions packages. Of course, we have 27 countries. That means that we all have to agree what we do in this. But we're constantly coming up with new ideas and working on this. On frozen assets, this is something that we have in our hands, and we clearly need to see what kind of next steps we can do. Using the revenues from the frozen assets is a first step, and we need to really discuss what we can do further. Of course, there are also sensitivities on the member state side, but I think it is important to think how we can really help Ukraine in this respect, because it's not right that our taxpayers are paying for the damage that we haven't caused.
She's also indicating that a new package of sanctions is being now worked on. Bloomberg has actually learned that could include the phasing out of Russian LNG and restrictions on imports of Russian aluminium. TTF gas is already up 50% year on year. You take out LNG, that potentially that price could rise even further. Let's get more on this from Bloomberg's Ollie Crook, who obviously was the other side of that conversation. Ollie, what else do we know about this next round of sanctions that is being proposed?
Yeah, so listen, Guy, these are the 16th round of sanctions that we're getting from the EU on the Russians. They want to get this through basically by February. And what we know about this is basically also this is a sort of crucial moment for these sanctions and really for the EU to find all the ways that it can to apply maximum pressure on Russia, because as we know, Trump is already talking about sitting down with Putin. We know he wants a ceasefire. He wants to get the situation resolved within the next 6 months. So for the Europeans, they need to think about how they can exert maximum pressure. One of the ways they can do it is, as we were just discussing, the oil price cap that is set right now at $60 a barrel. If they brought that down, that would sort of deplete some of the funding over for Russia. But one of the other things that they're discussing is these LNG imports. They actually had a record of LNG imports from Russia into Europe last year, 16 million tons. These are sort of going principally to Spain, to France, to Belgium. These are countries that will probably be less resistant to cutting it back. And there's another side to this coin, guys, is that if you're not buying that LNG from Russia, where are you buying it from? Potentially you're buying it from the United States. We have heard President Trump be be very, very clear that this would help the Europeans basically not be tariffed if they were to sort of adjust their trade balance by buying more fossil fuels and natural gas. There is also the question of aluminum. You know, the Europeans still get about 6% from Russia. That's down significantly since 2022, about half, but that's still a sort of a material amount. There's also the question of the shadow fleet. Apparently, we had the story out in the FT yesterday basically saying that a lot of these sort of docks in Europe are still servicing Russian ships and dry docking them. So again, there's some still holes in here. And of course, there's the last thing, the holy grail. It's these underlying Russian assets, these frozen Russian assets. There's that G7 agreement to basically talk about the principal, or not the principal, but the sort of the profits of those assets, $50 billion. There are $300 billion of these assets sitting right now within the EU. This is a very sort of contentious issue. The U.S. has pushed to start tapping these assets and sending them to Ukraine. This is another thing that they could potentially pull to exert that maximum pressure in potentially what could be the final months of this war, but we'll have to see what Trump does.
So, Ollie, Ukraine aside, what about Europe's own defence build-out?
Yeah, so listen, I mean, Rutte was speaking in Brussels yesterday. He went to Helsinki for this Baltic Sea Summit. You know, he's saying 2% is not going to cut it. Trump wants 5%. I think that the sort of Rutte wants to see something closer to 4% defense spending. The question around that is, as ever, how you're going to pay for it. I mean, they've just deployed the sort of Baltic Sentry. They announced this yesterday. Basically, there's going to be more drones and ships that are basically going to be patrolling the Baltic Sea to basically, you know, see where all these ships are coming from that are cutting these cables, dragging anchors. But the question is, that just shows you how much more hybrid threat there is. It is going to cost a lot more to do this. I talked to Kaja Kallas about this question of joint debt. Are they coalescing around this? I think the problem right now is you don't really have a plan. For those who are critical of this idea of joint debt, they basically see it as a solution in search of a problem. Until we get a sort of very clear plan for what this money would be used for and how sort of basically collective procurement at the EU level could start working, then you're not really going to make forward progress on this because you're going to get resistance from the usual suspects, the Dutch and the Germans. But I suspect, given the sort of fiscal stress you've got in France and Germany, really across Europe, and basically the idea that military spending is bipartisanly supported in most nations in Europe, that if you are going to see joint borrowing, it will be on defense.
OK, Bloomberg's Oliver Crook, we thank you. Great interview again. And coming up on the programme, as we inch towards the opening trade, we have futures pointing ever so slightly higher here on the Euro Stoxx 50. We're going to dive into the stocks to watch next. Chinese tech firm Tencent and the founding family of Ubisoft weighing a new venture to boost the value of the French video game publisher. We'll have the details next. This is Bloomberg.
14 minutes until gilts open here in the UK. We've had the CPI print out this morning, a little softer than maybe would have been anticipated, certainly by economists, was anticipated by economists, a little bit of respite for the Chancellor. What is interesting now is that the pound, after moving lower, the cable rate moving lower, we are now up on the session. How quickly do you fade any move? Instantly, it seems, maybe looking at sterling, off today's CPI print. Is this as good as it gets, as maybe Mark Dowding was suggesting a little bit earlier to us from Bluebay? Let's get another take on this from another Mark. Mark Cudmore joins us now, Markets Live Executive Editor. Mark, how quick? I'm fascinated to see sterling gaining traction as we speak on the back of this print. How quickly do you fade any move off this CPI print? Gilts will be opening in 13 minutes.
I don't think you fade it too quickly in terms of that extreme bearish sentiment was in the price. I think pound being higher makes sense. Look, I'm not trying to be rude or snide about the UK, but the fact is the UK trades like an emerging market now. And what I mean by that is that the currency has a negative correlation to its own domestic rates. So when bond markets sell off in the UK, yields go higher, the pound suffers. And that's because it is a small enough economy, and since it withdrew from the EU, it's relying on foreign funding of its deficit. And so it's a currency which has it rallies when its yields come lower in this environment. That's not always going to be the case, but right now, in a world of rising yields where we're concerned about deficits and debt, the UK is trading like a classic emerging market currency in terms of that as yields come lower, the currency will do better. So this dovish print that is supportive for gilts makes sense for the pound to rebound. Now, how quickly do you kind of fade this idea? I am worried about the longer term inflation trajectory in the UK. I'm worried about the global trajectory around inflation, and I wouldn't want to get too carried away on this one soft print. So in that regard, regard, yeah, sure, you should probably fade this relatively quickly. On the other side, there's such extreme bearishness in the UK. I'm in the lone camp that actually I think sterling dollar rallies from here. You've got an extremely bullish dollar positioning out there, and extreme UK negativity. Now, I know there's good reasons for both. I'm not saying they're flawed positions, but that means the asymmetric kind of set skew is just massive if there's any disappointment on either side, if Trump does not deliver what's fully priced in on the tariff side, or if anything positive comes through in the UK. So for me, I think actually cable can continue to bounce from here. And in terms of, yeah, you should fade the CPI story, but you shouldn't necessarily fade this cable move.
Well, Mark, you talk about how the UK is at the mercy of global markets. Is it US CPI that gilts really need to brace for?
I mean, at the moment, the dollar is the bigger component of almost every FX story. So yes, to a certain extent here. And I think that, a lot of people are worried about, fiscal concerns. But I want to emphasise that for the UK, what's happened there is it's because of its current account deficit. It's about the fact that it's foreign funding. And in this market at the moment, countries with large current account deficits are vulnerable, especially if there are structural ones like the UK. But yes, completely. To answer your question, Lizzie, US CPI is going to matter. And even though I do think that cable can bounce for it, maybe if you want to play a slightly more constructive sterling view, maybe it's on the crosses rather than better the dollar, because everything is going to come down to US CPI, and then after that it's going to come down to what Trump delivers next week, and that is what is looming over everything at the moment. Given that backdrop, I'm inclined to fade extreme positioning across the board, which makes cable just the pick of the lot in the FX world.
Cable, the pick of the lot. Mark Hudmore, your views on the yen as well, because we've been hearing from the Bank of Japan Governor Ueda speaking, saying that actually, to your point, US policies are now needed to be factored in, as well as those wage increases that he says he's seeing. And you're seeing a move higher in the yen in the session today. Do you lean into that, Mark?
I'm a deep structural yen bear, as you know, Tom, but I am someone who thinks that Ueda really, really wants to hike next week. Now, he cannot promise that hike. We will not get the usual leak to Nikkei saying what they're going to do, I think, until after we get some clarity on the initial stumps by Trump next week. And again, it is the US which really crowds out everything else at the moment. And this is why pricing for next week on the BOJ is a kind of split. I mean, it's slightly leaning more towards a hike at the moment, but you can't have conviction either way. You can't have large positioning either way, which is why it's actually set up to have a major impact, even whether they hike or not, it'll only be a small hike, but it'll have a big impact because positioning cannot be too large on the yen side of the equation until at least Wednesday or Thursday next week. People are going to have to put it on at the last moment. People are going to have to react to the BOJ. And that's why it's an interesting meeting. I think Ueda really, really wants to hike, but he, like everyone else, is going to wait till next Wednesday or Thursday before he really makes up his mind.
OK, needs a bit more clarity, particularly when it comes to the US on policy and inflation later today. Bluebay Markets Live Executive Editor Mark Hudmore, thank you. Remember, you can get up-to-date, of course, analysis and insight from Mark and the rest of the team. Just go to MLIV. Go on your terminal. Let's get your stocks to watch for the day now, bringing Joe Easton from our equities team as we lead up to the open. Joe, what have you got your eye on?
Morning, Tom. So it's a big morning for Bayer after the company finally got a verdict from a jury over in Seattle, which says the company will have to pay $100 million to a group of people that says that a school construction chemical was the reason for their health issues. They are looking at a payout there. This could potentially mean billions of payouts for the company over in Germany. They said in their statement that they do disagree with the verdict, so are looking to appeal. Now, this has been a heavy weight on the stock as we've waited for this update. We can see it down 66% over the past 2 years for Bayer, given the issues around this chemical from their Monsanto business. Then in terms of M&A over in the industrial testing space, we've got news of a merger between SGS and Bureau Veritas, potentially creating a firm with a market cap of around $30 billion. Now, the company have confirmed that they are in talks on a deal, but it is not yet certain that that will actually go through. There we can see Veritas, the outperforming stock. There was speculation around a deal between those firms a couple of years ago. We can see a few sell ratings on SGS at the moment. Maybe they will have to change their tune on that stock this morning. Then in the gaming space, Ubisoft back in the headlines as Tencent and the company's founding family say they're going to create a new asset which will keep some Ubisoft gains within it, potentially unlocking some value. Another stock that's had a really rough run due to some delays, including on their Call of Duty game recently. Now, the stock down 50% over the past 1 year, so potentially we're going to see some upside. We have some reports around a potential takeover by Tencent and the family recently. Then in terms of ratings, another busy day. Air France underway over at Barclays, likely to be weaker, and Anglo-American is cut to underperform at RBC today. Meanwhile, Exane has a big note on the takeaway delivery stocks this morning. Deliveroo is the one they like most. That one goes up to outperform, could be higher in London this morning.
All right, thank you to our equities reporter, Joe Easton, with our stocks to watch as we get towards the open. I've got to say, I'm looking at the futures picture here, and the UK is kind of all over the show this morning. FTSE 100 futures are more optimistic than Euro Stoxx 50 futures. The pound is up, despite BOE bets being paired on inflation undershooting. Is this just a reversal of the underperformance yesterday? Not sure what to make of this.
So I'm getting various views in the market on this, one of which stands out to me, maybe that actually what's happening here is that foreign buyers are buying gilts on the back of this, which would in some ways be logical, and therefore actually you just get a little bit of a pickup in sterling off the back of it. It's not a big move, but it's certainly there. We're going to find out in around 5 minutes' time. How the market reacts to this, I think, is interesting. Is this just being perceived as the calm before the storm? The inflation outlook is more difficult going forward from here. Yeah, you get a soft print today, but maybe that just makes the next print even harder to digest.
Well, it's hard to look through all those additional inputs that Mark Dowding of Bluebay was talking about in terms of the inflation story. Deutsche Bank put out a note saying the bottom line, the Bank of England will feel likely emboldened to continue its easing cycle in February, and you're at about an 85% chance now that happens on the market pricing right now.
Get another print before then that shocks the market. What happens on the back of that? Data dependency. Anyway, the opening trade is coming up next. The gilt trade is coming up next. This is Bloomberg. Wednesday the 15th, good morning. Couple of minutes to go until equities start trading here in Europe, plus also gilt start trading. We'll bring you that first gilt trade in just a moment. Let's talk about the legacy of Tuesday and what it's going to mean for Wednesday. US stocks, reasonably cautious session yesterday. Yeah, we absorbed the PPI number, but it's the CPI number today that we're really looking for. And as a result of which, I think we just kind of sat on our hands a little bit of a pickup after Europe had closed. So maybe that's being priced into futures this morning, Lizzy.
Yeah, as we await that US CPI print, we have Euro Stoxx 50 futures showing a bit of optimism this morning. Actually, FTSE 100 futures even more positive today. The UK really all over the place after that UK CPI print. Traders pairing bets on their Bank of England cuts. The pound higher, though. And then when we look at the French story, Tom, actually this political uncertainty removed somewhat because of Bayrou offering an olive branch on pension reform, so maybe injecting a little of optimism there into the Paris index. But what are you seeing in terms of stocks to watch?
Yeah, 2 cuts now being priced in for the Bank of England through this year. On stocks to watch, we've got a couple of deals in focus, potential deals at least. Before we get to those deals, Bayer at the top of that board facing potentially billions in payouts. This has been a long-running saga, of course, for the chemical maker. This is after the award of a $100 million verdict in a Seattle area school case. This is linked, of course, to its Monsanto unit. Ubisoft in focus, potentially doing a deal with Tencent around setting up a joint venture in which some of Ubisoft's assets would sit to increase the value of that company that's been under pressure. And SGS Bureau Veritas potentially in a more than $30 billion combination. So we watch those stocks as well. Guy.
OK, here we go. The opening trade Wednesday morning, bound to happen. Stocks are going to be very interesting. The FTSE's going to be interesting. Gilts are going to be interesting. Right, let's get some numbers for you and figure out what is happening here. Quite an interesting sort of series of factors, I think, coming through into the FTSE 100. And as you can see, maybe it can't quite make up its mind yet which direction it wants to move in. Maybe a more positive tone beginning to emerge. We're not up by a lot, but we are up. We're up by 0.2%. The 600's up by 0.1%. We'll see how the rest of Europe opens. We are, though, still arguably waiting for that critical moment a little bit later on, 7:30 Eastern, when we do get the CPI print in the United States dropping. That will probably determine ultimately where many of these markets are going going to close. The IBEX is up by 0.3. The CAC is up by 0.3 as well. What are we looking at, Tom, Lizzy, in terms of the sector story, the single stock story? We'll get on to gilts in just a moment as well.
Well, Guy, at the moment you've got all sectors in positive territory, bar two. So tech and healthcare, bottom of the basket today. Real estate leading the gains, higher 1.2%. Are we seeing a bit of a read-through maybe to tech from the chip story over from the US? But it's mostly green across the screen. And as you say, across the continent, the FTSE 250 actually the most optimistic this morning, Tom.
Let's get to the gilt move then. You are seeing a bid for UK sovereign debt right now. So there's the calming balm for Rachel Reeves, at least for now, with yields down 8 basis points at the front end, with the 2-year yielding 4.52. And it is bid along the curve as well towards the back end. The 30-year is now at 5.38. Yields down 7 basis points. On the 10-year, the benchmark now at 4.80. Now at 4.80 on the 10-year, with yields down 8 basis points. The pound, again, rallying at 122, Guy.
The two, you can understand the connection. I come back to the point that maybe foreigners are buying gilts this morning. Certainly see evidence of that. You look at what is happening elsewhere across the continent. Bunds down by 3 basis points this morning. You've got gilts down by 8 basis points. So maybe there's just a bid coming in. Maybe that just increases the bid coming through in, therefore, for sterling. But we come back to kind of how long is this going to be sustainable. In terms of what this means for the FTSE 100, what is interesting here is that you are seeing the FTSE 100 bid up by around 0.6%. You would have thought normally sterling goes up, FTSE goes down, but that doesn't seem to be what is happening this morning.
No, indeed. But if we think about the inflation picture, well, let's look at some of the movers that are moving this morning. If we could just bring those up. Some of the biggest movers today. National Grid, higher 1.9% in the green there. ASML at the bottom of the basket, though, on the board there, down 0.6%. Hermes suffering, down 0.9%. LVMH as well, down more than 1%. So luxury suffering today, Guy.
But oil stocks are higher. And that's off maybe the oil story we were talking about a little bit earlier on, to the sanctions story and what is happening coming out of the EU. So you've got Shell tracking a little higher this morning. You basically got UK banks and UK oil companies both rallying. So Lloyds is up. You've got Nationwide up. You've basically got UK banks looking, NatWest is up as well. UK banks are looking fairly favourable. BP's up. Shell is tracking a little bit higher as well, which is interesting given the sterling move, but the oil move is positive. And then GSK, big foreign earner, actually tracking a little bit higher as well, but it moved lower yesterday.
Some of the retailers in the UK that got badly hit last week are seeing gains. So Kingfisher is up 2.4%. You're seeing gains for B&M. Next is also up 1%. And JD, which has been under pressure, is currently gaining 1% as well. But how long-lived will this upside be when it comes to the UK as we moderate around the views on inflation? Again, markets now pricing in 2 rate cuts for the Bank of England. OK,
so temporary relief here in London off the back of that softer than expected UK CPI print. But, of course, all eyes now on US CPI coming later today. David Costin, Goldman Sachs chief US strategist, spoke to us yesterday with his view on the path ahead for inflation and, of course, the impact on markets as well.
Our expectation is that inflation is coming down slowly, and that bond yields will fall over the rest of this year, something closer to 4.25% on nominal yields, down from the current level, which is much higher than that. So I'd say that's a big area of focus for fund managers.
OK, joining us now is Sharon Bell, Senior European Equity Strategist at Goldman Sachs. You heard the view there, Sharon, on the US. When we think about the UK this morning, the data dropping, are you of the view that this is going to be short-lived, that the problem is actually going to continue?
Look, the UK obviously has some problems. It's got twin deficits. It's got a trade deficit. It's got a fiscal deficit. And these are very tricky things to tackle, and they're not going to be miraculously cured with one inflation print. That all said, it is good news that inflation is moderating a bit, because it does just give the Bank of England a little bit of room to cut interest rates. We expect them to cut at the February meeting. And the market is now pricing in a little bit more cuts for this year, and that is some relief to the UK economy. Yeah, the market agreeing with you. In terms of the US, even if the data is a relief now, even if that draws out more stock bulls now, I wonder, can it last, given all the uncertainty on inflation in the US picture? Yeah, and look, oil prices have risen recently, and that obviously is one of the big triggers that we saw in the last couple of years to higher inflation. So we obviously are looking at that. But we generally think that inflation from these very high peaks that we had a year or two ago has been trending down or will continue to trend down. central banks like the Fed have been cautious in their cutting cycle, partly because they know that the economy is reasonably strong in the case of the US. They want to cut cautiously, so reflecting this idea that the labour market is pretty strong, the economy is not particularly weak in the US, and when it comes to inflation, it's driven by things like global goods prices, energy prices, and they are down a long way from where they were a couple of years ago from their very heady highs. So we do think inflation is moderating. That will help bond yields ultimately come down. But the path is never a linear one, straight down. There will be bumps along the way.
So to protect on those bumps, where are you looking for downside protection if you do want to be adding in an environment of still high yields?
Yeah, I mean, certainly you can look at downside protection in places like gold, for example, and a lot of people go to gold because it's a safe asset. It's one that does a little bit better when you see risks rise, like we've had recently. So I think that's potentially one place that you could consider. Another place that you can consider is, and people have done a lot of this in recent years, is to look at US stocks, which are kind of not just the Mag 7, those core companies, but kind of broadening out your exposure to the US as well, so that you are not sort of concentrated in terms of your risk. So you can try and look to do that. The other place, I would argue, is that, you know, the safer parts of the bond market where yields have already gone up now and offering you quite a good yield. So we're actually, within our asset allocation, overweight both equities and government bonds, underweight credit, which we regard credit spreads as super narrow at the moment, but bond yields at these levels we would see as quite attractive bonds.
OK, so you're buying bonds, and which parts of the equity space is most attractive at this point? Because the relative value, the nominal value question that we were talking to Sebastian Redler about yesterday, how do you balance the kind of the relative value story for Europe?
Yeah, look, it's a tricky one. We still actually think the US will deliver better returns than Europe over this next year, but it's a closer call than it's been, I would argue, in the last year or so, because Europe has already underperformed a lot, and the US equity market trading on a PE of about 22 times is towards the top end of its range. So the US trades at a high valuation, but we do think, all other things equal, we have an environment where inflation is gently moderating over time, albeit a bumpy path. Yields will eventually reflect that and come down. And with the Fed still in a cutting cycle, even if it's not as sharp as many people hope for, no recession in our forecast. That's all quite good for risk assets like US stocks.
So we talked to Sebastian Redler from Bank of America yesterday. He thinks that if the US markets fall by 10%, say the S&P goes down by 10%, he thinks the European markets go down by 5%. Is that your view as well? Do you think what's the beta
yes,
here?
I probably do agree with that. Historically, you'd say Europe tends to correct more than the
exactly.
US. So you wouldn't want to go into Europe. But I think that if you look, for example, in the summer of last year, when you saw a tech-driven correction, Europe and UK, for example, which has very little tech exposure, barely fell at all. So I do think the US has got certain vulnerabilities because of the concentration of returns in recent years in 5 or 6 companies, and because of the high level of valuation, that does make it a little bit vulnerable to a correction. We don't necessarily see the big triggers over the next 6 months to that, given that you've still got inflation coming down in our view, rates coming down, reasonable economic growth. None of that would suggest to us that you see a very large correctional bear market, but the risk, of course, is there.
Would parity on euro-dollar be a trigger for US investors to think more seriously about investing in Europe?
I don't know about that. The problem is the way you get parity and a lower euro or a lower sterling is normally because risk events have gone up in Europe.
Sure.
People are suddenly worried about France. People are suddenly worried about the UK.
But you've got a super cheap currency. You're a US investor. That's already in the... So you've got that.
Yeah.
You've got super cheap valuations. Like, what is the catalyst?
To get US investors interested in Europe. Look, actually, US investors' flows into Europe have been OK in recent years. It's European investors that aren't buying Europe. They're the ones
buying America,
deserting Europe and going off and buying the Mag 7 and the US. So it's those ones that we need to retain in Europe. I mean, absolutely, it's helpful if global investors buy Europe, but I think it's more, we need more domestic bid.
It was interesting this morning, we heard from the ECB's Philip Lane at some ungodly hour speaking, but he was saying that the central bank can't ignore the currency story forever, but it's companies that will absorb it first. But when you think about the broader picture geopolitically, we haven't talked about Donald Trump yet.
Yeah.
Is it actually the UK that becomes more attractive here because it's kind of shielded from the impact on China and the EU directly, because we're not such of a threat in terms of goods trade with the US?
Yeah, I mean, we have been arguing this. I very much agree with that. The UK isn't an economy which is dependent on global trade and manufacturing in the same way as, say, Germany is, which is super exposed both to China and super exposed to the US in terms of goods trade. The UK is much more services, much more finance, etc., and they're less impacted by tariffs, so completely agree with that.
If you want to fade UK risk, you have a call on FTSE 250 on the small and mid-caps. Just unpack that for us.
Yeah.
I mean, how much conviction do you have in that view?
Yeah, look, it's always a more risky one, isn't it? Because FTSE 250 is quite high beta to all these UK events. But I do think, I mean, our view on the Bank of England is that the bank's got too cautious a view on cutting rates at the moment. Their view on UK growth this year is probably a little bit too high. As that starts to moderate through this year, it will give more room for them to
Two cuts is still too cautious, do you think, for the BOE?
We've got quarterly cuts for the Bank of England. We think that these recent events made us even more of the view that they would cut in February. All of that would be supportive of the 250. But, I don't disagree. There are lots of risks involved in this.
Are we about to see taxes going up and all kinds of factors which are likely to hit the domestic economy more? It's either taxes go up or cuts get priced in terms of the spending from government.
Yeah. So there are, taxes are going up, although a little bit of spending is going up as well, which adds to UK economic growth. So, look, on balance, I think it's a combination of us thinking that there's a lot of risk already priced in into UK assets generally and into the FTSE 250.
That's been like that for ages.
Specifically. Well, yes, except even more so now. But then I guess you could argue risks have indeed gone up in the last couple of weeks, which I'm sure that they have. But valuation is low, a lot of risk is priced in, and I wouldn't be in the camp that you see a recession in the UK.
It's great to see you, Sharon. Thanks for stopping by to see us around the table. Thank you very much indeed. Sharon Bell, Senior European Equity Strategist, joining us from Goldman Sachs. Let's take a quick look at the centre of gravity here in Europe. This is what the Core 6 looks like in terms of the major stocks that we track. As you can see, Schneider's the only one higher. Lilly got hit really hard yesterday, and that move looks like it's continuing into Novo Nordisk. Eli Lilly under real pressure in the US session, but LVMH continues to drop. Ferrari's a little softer as well. Even Nestle, one of the safest stocks in Europe, though you could argue not over the last year, is down by 0.2%. What else are we watching? Joe Easton, over to you.
So we are seeing some movement in these testing stocks. Sky, remember SGS and Bureau Veritas confirming that they are potentially looking at a deal for a takeover. We can see Veritas coming up around 4% at the moment, and SGS going the other way, potentially reflecting the amount of money that may have to be paid out on that deal. SGS has been the underperformer, and it does look to continue at the moment. But interesting news in that space. There's a couple of other stocks moving on that, including Intertek in the UK. I saw that one edging up. Then in terms of the UK mid-caps, as Sharon was discussing there, it's all about the rates outlook. We are seeing yields coming down on the gilt yields pretty significantly this morning, and therefore that is feeding into the home builders, in particular Persimmon, also Vistry. Both of those stocks coming up. I think Persimmon also upgraded over at Deutsche Bank as well, potentially helping the outlook on that one. Hayes, meanwhile, gives an update. Weakness in the UK employment market, but we've already seen a lot of that coming through from the likes of Page Group, Robert Walters as well. So potentially this is actually priced into the market, and we're seeing that stock coming up. And then the big one, Curry, selling loads of TVs and dishwashers, because that stock coming up 11% following a Christmas trading update. The profit guidance looks pretty firm on the Currys for that stock at the moment on that one. Then in terms of the other shares on our radar, we were looking at Ubisoft because, of course, that news around a potential asset deal, a joint venture deal with the Tencent and founding family of the company, edging up 1%, but still down heavily over the past year for that one. Meanwhile, Bayer paying out $100 million to a group of workers at a school in Seattle, but potentially that was not as bad as some people had expected. It does point to billions of potential compensation payouts for the company related to their Monsanto unit, but that looking like a little bit of relief from that verdict, although $100 million does sound like quite a lot of cash. Then in terms of rating changes, Air France, that one did get a downgrade. That was over at Barclays, and we're seeing that reacting. It is underperforming, down 0.4%. Underweight on Air France. They've had some issues, of course, around the fuel costs recently. That has weighed on the sector, potentially playing into that one. And the other one on my radar was here in London, Anglo American. This one also had a rating change. That was over RBC. Of course, the outlook pretty much dependent on China for that one, but their price target 2,200 pence, still some significant downside. Anglo coming down 1.8%. Another stock moving here in London this morning.
Joe Easton from our equity team, thank you very much indeed on some of the stocks on the move. Let's get back to what is happening with gilts before we take you to the break. You are seeing money moving into UK sovereign debt. On the benchmark 10-year, yields are down 7 basis points at 481. At the front end, yields down 8 basis points, 452, as traders ramp up expectations for another cut in February. Coming up, the US doubles down on China chip export restrictions. We're going to look at the implications then for the producers, including TSMC, Samsung and Intel. That's coming up. This is Bloomberg. Welcome back to the opening trade. We are 19 minutes into the Wednesday session. We've had the inflation data, more benign out of the UK. We build up to the CPI print of the US, of course. European stocks are up 0.2%. You're having a decent session here in the UK with the FTSE 100 up 0.6. The DAX over in Germany up just 0.1. Over in France, though, a bit of softness, down 0.1%. Let's get to what's happening in terms of further restrictions on chip sales into the Chinese market, because the US is planning new regulations to stop China getting hold of advanced chip technology. The latest measures are expected to put the onus on chip makers themselves to carry out more due diligence on their customers. For more, we're joined by Bloomberg's Bill Ferries. Bill, what is the prospect then? What is the rationale behind these measures? How much more complicated does it make it for the foundries looking at those Chinese customers?
Well, Tom, the goal here from the U.S. perspective is to stop the flow of some of these chips through third parties or backdoors to Chinese companies that are already basically blacklisted, like Huawei, for instance. So the new restrictions would target chips in the 14 to 16 nanometer range. That's a range that is not typically thought of as advanced chips, but there was some alarm when chips from TSMC were found through a third party to have gotten into Huawei technology. On the other hand, the U.S. restrictions would allow companies like TSMC, Samsung, Intel, if they do a certain amount of due diligence and know their customers' needs a little bit better, to allow them to continue selling into China. So the idea is to provide incentives for these major manufacturers to be able to continue their sales if they have done an additional few layers of due diligence on who exactly their clients are and whether those clients might turn around and sell their chips to other companies in China.
So a parting shot perhaps from Joe Biden. Another parting shot, the SEC filing a lawsuit against Elon Musk, Bill, over his acquisition of Twitter. The accusation that Twitter shareholders were done out of millions of dollars by waiting too long to disclose that acquisition. Is it a parting shot by the outgoing administration against Musk, or is it going to have real consequences?
Yeah, the SEC argument here is that Musk passed that 5% ownership threshold in Twitter in late March 2022 and then waited too long to disclose that to investors. In that time, he continued to buy hundreds of millions of dollars of Twitter shares that would have presumably gone for a higher price had they known Elon Musk was the main buyer. It's hard to know right now. There is going to be a much more a friendlier SEC chair coming in when it comes to big businesses and fines. The Trump administration is unlikely to want to pursue this, but it is. We'll have to see after January 20th whether this is something that Elon Musk really has to deal with, or it's going to be kind of a symbolic parting shot from the Biden administration.
Bill, great stuff. Thank you very much indeed, Bill Ferris, on what is happening in technology. Let's turn to banking. Big day for global banking. Goldman Sachs, Citi, JP Morgan, going to be reporting numbers. We're kicking off the earnings season unofficially today. The 5 biggest banks are expected to post a 50% rise in fourth quarter trading revenue. Let's talk about what we should be looking for in the details. Bloomberg's Charlie Wells joining us around the table. Expectations are high. The stocks have risen really sharply. Can they deliver?
Yeah, I think that's a question, like how much of this optimism that we saw in 2024 is baked in and how much room is there to run for these bank stocks? The story last year was really good and it kind of changed over time. So there was this expectation of rate cuts. The rate cut came. There's that uptick in deals. Then we got into the U.S. election. We saw all that volatility, and we are expecting to see some near record revenue for a lot of equities trading desks. So that's really positive. But I think going forward, does this continue? I think, analysts like Mike Mayo have been saying there's room to run. He said that he's over at Wells Fargo. He said that, we're entering a new era for banking. But do recent trends in the markets pose more problems for banks in the year ahead?
Charlie, in terms of the language from executives on the calls with analysts, particularly around guidance, what are you and the team going to be watching out for?
So it's Trump, right? I think that's the thing that everyone wants to know about. And I think, after the election, there was this huge sugar rush for bank stocks because of this one word, deregulation. Bank stocks, I was just checking a few minutes ago, they're hardly up from the day after the election. So it kind of went up and then is now kind of down back to roughly where they were. And I think there's sort of 2 questions here on the year ahead. It's what does deregulation actually look like? Can legislation, can rules change given the unpredictability that we know this incoming administration will almost certainly have? And then there's that market question of do the policies that this new administration bring in, particularly tariffs, are those inflationary? Do those mean that yields are higher for longer, at least somewhat higher for longer? And how does that change the sort of uptick in the deal flow that we've been hearing about? But are there some positives there as well for things like net interest income?
Also, more talk of succession planning at BlackRock and JP Morgan. What do you tell us?
Yeah, Lizzy, this is really interesting. So, Jen Pipsack was named COO at JP Morgan yesterday. We heard that Daniel Pinto will be retiring at the end of the year. And then over at BlackRock, largest asset manager in the world, a senior executive is departing. Of course, last year there was also the departure of Salim Ramji, who went on to head Vanguard. And this is all kind of adding up to this issue of some of this is seasonal, right? You get a lot of arrivals, promotions, departures early in the year, but also generational, right? A lot of these founders, a lot of these executives are boomers. I hate to throw that word out there, but they're in their late 60s, early 70s. Many of them either founded these companies or over the past few decades have been transforming them into what they are today. It's hard to leave. And I think there's a lot of questions about the largest bank in the U.S., JP Morgan, the world's largest asset manager, BlackRock. What happens to that leadership in the years ahead? A lot of questions from investors on that.
Okay, succession in focus as well ahead of those bank earnings with the setup and the preview. Charlie Wells, thank you very much. Indeed, a line crossing just on the chip story that we were discussing a moment ago. The Dutch, the Netherlands, the government there to tighten export controls of semiconductor equipment. Of course, they are home to some major producers of semiconductor kit, including, of course, ASML. That stock down 0.4%, but paring some of the heavier losses. This on the back of further restrictions being announced regarding and from the Biden administration, focused largely on TSMC, Samsung and Intel. But ASML a little softer, down 0.4%. The Dutch making some moves as well.
Coming up on the programme, we're going to talk to someone in a sector that's really affected by the inflation story here in the UK. Of course, we had that miss on CPI, traders adding to BOE bets. We're going to talk real estate next. Investors naming their top destinations for real estate investment in Europe. We'll find out if London can keep its title. So do stay with us for that conversation. Coming up next, this is Bloomberg.
"30 minutes into the equity market session, 30 minutes into the gilt session as well, which is interesting given the outlook we've just got on inflation. Where that story goes to the UK remains to be seen. But at the moment, you do see a bid back into equities. Feels like we're in a holding pattern, though. You've got US CPI data coming out a little bit later on. That, I think, will determine ultimately where many of these markets are going to be closing. It is out at 7:30 Eastern. 1:30 London time, so look for that a little bit later on. We've also got some comments coming through from the ECB as well. The ECB's De Guindos talking about the outlook for the euro area economy. He's talking about it remaining weak. He is talking about the conditions being in place for growth to improve, but he's not exactly painting a positive picture when it comes to the growth outlook. And this is the problem that we not only see in the euro area, but also in the UK as well. You've got a growth problem. And that's going to be represented, maybe, Tom, as we see the GDP figures coming through tomorrow as well.
90 basis points of cuts priced for the ECB through the rest of this year. We focus, of course, on the UK as well as traders ramp up the bets around February. 86% chance now that you do get a cut from the BOE in February, given the softer than expected CPI that came out. 2 rate cuts now priced in fully for the full year 2025. So let's check in on the markets, and you are seeing moves into gilt. So some reprieve for the Chancellor, at least this morning. The 10-year is bid. Yields are down 6 basis points at the front end. A little bit more activity. Yields down 7 basis points. 453 on the 2-year, 483 on the 10-year. Bunds in focus as well, just given the spread versus OATs. The French political story shaping up as well. German Bunds currently at 263. Yields down 2 basis points. And French debt, 345. Yields down 2 basis points. Getting a stay of execution, at least for now, in terms of an alignment with the socialists. How long that will last is in question. The US benchmark 10-year, 477 as we build up to inflation data out of the US. Yields down 2 basis points. Now to London and what is happening in the real estate market, where, of course, rates are central to the story as well. Again, and London coming top, once again, in a survey of the most attractive European cities for cross-border real estate investment. The research by CBRE has also found that investors expect the highest returns from the UK overall. Let's get more then on the findings from Chris Brett, Head of Capital Markets for Europe and CBRE. Chris, of course, we want to get into the details of the findings in the survey, but I do want to first start on the rate story, given it's front and centre for us right now. How much of a challenge is higher rates in terms of investment flows into real estate? How much pressure is there on the sector right now?
Well, I mean, we've seen that 2024 was better than 2023. We're expecting that to continue. Rates clearly have a very big impact on borrowing costs around real estate, and that balance between what the cap rate is and where the rates are is absolutely critical. However, with the ongoing price recovery and discovery, actually rates are accretive to many parts of real estate because of the market price movement we've seen.
Do you see some clear out in the sector on higher rates? I mean, something's going to break at some point if we get... So fine, we're pricing in 2 cuts from the Bank of England, but that's far fewer than markets had expected 6 months ago. Which parts of the market are looking most vulnerable at this point?
I would say that most vulnerable is certainly going to be around some of the secondary office markets that we've seen have real pressure. They've had real pressure over the last few years post-COVID. However, I think the flip side to it really is actually the occupational side that we're seeing with the strength of the leasing markets, particularly around some of the key cities around Europe and globally, is actually stronger than everyone's expecting, thus giving us a really strong platform for 2025.
Are Londoners coming back to work anytime soon? Is that going to... how big a feature of the landscape is that going to be?
Guy, good morning. I think that the return to office is becoming an overplayed story, okay. particularly in mainland Europe. I have the benefit of travelling around quite a lot, both in Europe and globally, and I don't see many empty offices in the European markets, or certainly in an Asian market.
Compare London to Europe. Is London different? Feels different. I get the train pretty regularly, and it's kind of still busy Tuesday, Wednesday, Thursday. Monday's getting better. Friday's still empty.
But Friday was a day we never measured before COVID.
OK.
Right? So I think that you feel the office is definitely full. I think that actually when you look at what's happening in the office market generally, and this follows through to actually the battle for talent, and you see how much corporates are wanting to invest in the real estate and actually give their talent pool the best possible place to work, and that is showing, as I just mentioned, a real impact on occupancy and the rental levels that we're seeing in that part of the
top
market.
end. So top end looks good. People want to come into top end. That market looks really solid.
Yeah.
How much further does the spread get between top end and everything else? Does that divergence continue in 2025?
Look, I think that if you look at the last few years, you would say that the top 10% of any market globally, any office market globally, has been exceptionally strong, both from an occupational perspective and also from an investment perspective. I feel that that is going to widen to the top 25% of the market,
right,
which still, I guess to your question, still leaves what is going to happen to the rest. And we're seeing an ongoing evolution of the change in office to other sectors, so whether it's student housing or residential, and that is an ongoing evolution we're seeing in real estate generally.
Chris, if we could talk about life beyond the office, Spain's been scuppering my retirement plans. They're planning this 100% tax, perhaps, for home purchases there for non-EU residents.
Yeah.
How much do you think that's going to affect house prices there?
Well,
Property prices in general.
Well, I think, look, from a residential perspective, it's going to clearly have an impact. From when you look at it, take a step back and look at it more on a generic perspective and look at it from an institutional perspective, Spain is still a very favourable market for institutional and private equity capital. So whilst it might affect your specific retirement plans, I don't think overall it's going to have a big impact on the commercial and residential market in Spain.
And let me ask you about Donald Trump's impact in your world. We've talked a lot on the programme about how long ESG can survive in its current form with him in the White House. What premium are investors willing to pay for sustainable assets this year?
Well, I've sort of said it a couple of times now. I think really on the occupational side, when you're seeing how much rents are growing in the top ESG buildings in major cities around the world, we're really seeing a very strong premium compared to what it was pre-COVID. But in terms of other asset classes, it has less of an impact, but ESG is still a very important factor for both institutional and private investors across European real estate.
Chris, the UK government came out with their AI strategy this week. Part of that is around data centres. Has the investment and the commitments around data centres in the UK kind of run its course? Is there much further to go on that, or is that going to be the strategy going to prove catalytic in its own space? What is the demand around data centre build?
No, I think the demand around data centre build is absolutely enormous. You had somebody on one of your programmes yesterday who was representing one of the big hyperscalers suggesting there was an 80 billion commitment to building data centres within that organisation. The challenge around data centres is around land and power, and that is the big next hurdle that I think the market needs to get over. But
has the government got the answers for those two challenges?
Generally, I don't think anybody's got the answers to those yet. All right, it's because the concentration risk is so great that actually unlocking that power is a real challenge for everyone.
Okay. In terms of the amount of investment you expect, how do you see the next few years working out? The UK has got to fix planning, it's got to fix the infrastructure, it's got to figure out what's going to happen with water. The ability to build in the UK, how problematic is it at the moment outside of the square mile, outside of the kind of the core centres when it comes to the office market? What else is happening outside of that space? Is there still strong demand to build? And what are the restrictions that are being placed on that? Is the market being throttled back at the moment by some of the issues you just raised with Tom?
I think that the UK planning system has a historic challenge and it needs to be revolutionised. And that is not an impact on people wanting to build, right?
Yeah.
The desire to build is definitely there. But there is a difference between the desire to build and the ability to build.
That's a priority for Keir Starmer. Has he not done enough on that?
Well, you'll have to ask him that, I think. But it should be. It's been a problem for a long time, though.
You're being very diplomatic, but you're talking about an issue that has been that long-running problem. They've talked about, as Lizzy is emphasising, this has been a priority for the government, but it suggests you are not seeing material action on the ground yet from this government to really address those issues.
I think that's a fair comment, yeah.
Okay.
Yeah.
Great to see you, Chris. Thanks for
you.
stopping by to see us. Chris Brett, Head of Capital Markets Europe for CBRE. Coming up, VW braces for another tricky year with no new electric car models. We're going to bring you that story next. This is Bloomberg.
Welcome back to the opening trade. We are 43 minutes into today's session. European stocks a bid up 0.4%. You're getting some decent gains here in the UK with the FTSE 100, as you can see, up around 0.7%. Stocks are up in the UK and bonds are getting a bid as well, with yields down 6 basis points on the 2-year, 5 basis points on the 10-year at 4.83. Now, the EU's climate commissioner says tougher climate targets would give predictability to the auto industry rather than being a hindrance. He spoke exclusively with Bloomberg's Ollie Crook in Brussels.
This is a tremendously important industry for Europe at large. I think it employs roughly 13 million people in Europe. It is hugely important for our overall GDP, and we will we will go to great length. We'll do our utmost to secure that this sector has a very bright future here in Europe, full stop. Having said that, many in the car industry actually tell us at the same time that we need predictability, that we need to stick to the 2035 goal, and that we can be much more effective in helping them out in making sure we protect the level playing field, in making sure that the loading infrastructure that people need to drive from A to B is actually there. And frankly speaking, I think Europe should do a better job, a member state should do a better job in investing, that they need way more investments in the grid. So I think that package in the end is far more effective. Now, you're going to tell me that I didn't answer your question and you want to know about the fines. I cannot yet say how that eventually will play out. But what I can say is that we had roughly the same situation, I think, in 2020, when just before the deadline, there were huge worries about how these fines would play out. In the end, only one company was fined, and it was only a fraction of what was anticipated.
So then what can we expect in terms of these fines? Well, how much money do you think we're looking at for these car makers?
What I think is here again, we should not look at this one-dimensionally. What we need to do is we need to make sure we have a dialogue with all the main stakeholders in this, again, tremendously important sector that we will never, ever let down. And that is precisely what Ursula von der Leyen is embarking on. Have a dialogue on all the necessities, also all the requirements, because make no mistake, various players in the sector have different demands. Some might like to change part of the regulation we have. Others are ferociously lobbying us to keep things exactly as they say, because they are saying, well, we already made the investments. So I think what we need to do is take the full picture, have that conversation with them in the weeks to come, and then come up with a long-term and short-term solution that is good for Europe and that is good for them.
And that was Wopke Hoekstra, the European Commissioner for Climate, Net Zero and Clean Growth, speaking to Bloomberg's Oliver Crook.
OK, let's talk about 2024 and what 2025 is going to look like for Europe's biggest automaker. Volkswagen is facing another tricky year. Deliveries are at risk of slumping again, with its namesake VW brand actually having no new electric car models due out this year. Adding to that, software delays are pushing back key products. Bloomberg's global automotive editor, Craig Trudell, joins us for more. That sounds really bleak. That sounds like a company that's got its back against the wall. Is that really VW?
I think this is a case of stubborn issues for this company that for some years now they've been trying to overcome and really struggled to do so. I think especially on the software front, where you did actually have for a time a sort of a barrage of product come from this company. The VW ID, sub-brand of electric vehicles, there was a lot of hype, a lot of hope for those cars. I think they came to market and really let a lot of people down, including Volkswagen's own customers. There was a lot of glitchy software. There were real issues with these vehicles that, to their credit, they've worked through some of those to this point. But I think the damage was done in terms of reputation. I do think that if you look at VW's electric models relative to the competition and think about how many of them they're going to have to sell, to go back to this conversation about fines and hitting EU climate policy goals, they had to sell an awful lot of them in order to avoid having to either get fined or pay, say, a Tesla to avoid.
Do we think those fines are going to really happen? Do we think those fines are the reality, or at some point is Europe going to have to look at its car industry and go, actually, progress is a little slower than maybe we anticipated?
I think it's really hard to say. I think there's absolutely going to be a sympathetic ear to the idea of what are we doing getting our European companies to take money out of their pocket and put it into the pockets of, an Elon Musk or BYD in order to comply with our laws. On the other hand, this is a sector that is responsible for, more emissions than any other.
Yeah.
And, this is also an industry that has really sort of dragged its feet and not been able to execute. And this has not been an issue of a lack of investment. It's been a lack of execution.
Are there lessons that VW could learn from Toyota? Toyota has not gone full bore on EVs. The circumstances are different, obviously, the regulatory requirements in Japan. They've gone with a hybrid structure. Is that paying off for them? And will it longer term for Toyota?
I do think that, if we could, sort of turn back time and think back to, rather than invest so heavily in diesel and bet on diesel, had Volkswagen followed the Toyota strategy of at least, partially electrifying their lineup and doing so really aggressively, I think we have seen that absolutely pay off extremely handsomely for Toyota. I think even Toyota is now in a position where, just the sort of conventional hybrids, the hybrids that do not plug in, will only take them so far. And so they do absolutely need to offer more fully electric vehicles. And they, too, are under some pressure, I think under a lot less pressure than a Volkswagen, in part because they are so much smaller in this region than Volkswagen.
You hinted at this, Craig, but, on Monday we saw Tesla overtaking Audi in terms of global car sales for the first time. I wonder how significant that milestone is, whether actually what you're saying is these aren't company issues, they are company issues, they're not EV issues in general.
Yeah, I think, Audi has maintained its position at sort of higher end segments, and we've seen Tesla over the last few years really come down pretty substantially and become basically a true two-trick company of a Model 3 and Model Y. And you can get those now for, 40,000 euros or less in some cases. Audi, of course, plays in much higher price segments. And so we're talking about two much more different companies than we maybe thought about a few years ago. But I do think it's really significant that a company held in such high regard that, for a time was really competing head on with Tesla has now fallen behind. And I don't think that the Germans, can be particularly happy to see that development.
Is the Chinese market now closed? Basically, for some of these big European car companies, the EV lead is so substantial now from companies like BYD that catching up is going to be nigh on impossible.
I think one of the things that was really interesting yesterday when Volkswagen released its, group deliveries for last year, they talked about, holding out hope for 4 million vehicles delivered in China again, sometime in the next few years. That's going to be really, really tough. I think, to reverse this trend that has been, really universal across the industry. You've just not seen international car makers be able to maintain their position in that market, and in no small part because of, as you say, the electric vehicles from the domestic players are just that much better, more competitive on costs. I think it's going to be really, really, we're going to have to see sort of a fundamental shift in the way that these companies have been operating. And, maybe we see Volkswagen take advantage of, sort of working with, in XPeng and learning from the locals and finding a way forward. But it's going to be
particularly on software, right?
Yeah,
the Chinese don't get software wrong in their cars.
Correct.
Generally.
Yeah, I think that's generally the case when you look at least sort of the owner surveys, the work that's been done on just how different and how much better, and also just how iterative they are. Their ability to sort of on a dime offer new features and scratch the itch of the consumer in China is far superior.
Well, it's a fantastic big take on Toyota. Craig Trudell, thanks for bringing it to us, and all the other moving parts in the car industry. We thank you. But we've got a busy day ahead of us. We've already had UK CPI still coming up. We've got at 10 a.m. London time Euro area industrial production numbers. At 1:30 p.m. London time, of course, US CPI. Then 7 p.m. London time, the Fed Beige Book. And later on today, Trump's cabinet confirmation hearings, including for Marco Rubio, the former US House representative, and John Ratcliffe as well. Later, Fed speak across from loads of Fed speakers, actually. Barkin Dowding, Kashkari, Williams and Goolsby all speaking in the afternoon UK time. And then on top of that, later in the day, we've got Wall Street earnings coming from Wells Fargo, JP Morgan, Citi, Goldman Sachs, BlackRock, all reporting as well. We have had that UK inflation number softer than expected and a reversal of the recent gilt moves. You're looking at the 2-year gilt yield lower 7 basis points at 4.5%, the 10-year yield lower 5 basis points at 4.8%. Bit of a relief, perhaps, for Rachel Reeves. Does it continue after the US CPI number later? Let's discuss now with Jamie Rush, Chief Europe Economist for Bloomberg Economics. Jamie, just talk us through what's behind this softer print on UK inflation. Is it perhaps not the end of the UK inflation story?
Well, so look, it was services inflation which dropped, right? And there are loads of different ways of cutting services inflation. You can look at the headline rate. You can exclude things like airfares, which bounce it around all over the place. And so when you look at it, you see headline drops a lot. Like core services dropped by quite a bit less, but still, move in the right direction. And if you look at the big picture over the past 6 months, you see that services inflation is kind of drifting into the sort of territory which is consistent with the 2% target. So big picture is that it's moving the right way. The Bank of England is going to be able to ease, and this, of course, means that Rachel Reeves will be able to catch a break.
And she probably will do it, at least for 24 hours or so. Jamie, what is your expectations on BOE rate cuts then, as traders price in now two cuts? Does that align with your view, or are you expecting more?
We think they'll do more. We think they'll do 100 basis points.
100 basis points?
2025, once a quarter. Again, reflecting that view that underlying inflation is coming down. We are going to see headline inflation drifting up a little bit over in coming months, but it's not going to be enough to trouble the BOE.
Gas prices are going up. Price fix is an issue. We've seen the BRC overnight talking about the food prices are going to be going up. They see that being passed through as well. Rents remain really elevated. The airfare story looks like maybe actually the survey period probably suggests that next time round we could maybe see a pop higher in that space as well. There's plenty of other factors, aren't there, creeping into the inflation outlook, which suggests that it's going to be a struggle from here. We were talking to Bluebay a little bit earlier on, saying this is as good as it gets. It's going to get tougher from here.
There are some things that are feeding through. You're right about gas prices, but, let's not get hysterical about them. They are not moving to levels that we saw during the energy crisis.
Sure, but they're up 50% year on year.
Yeah, but that is modest compared to... If you look at the level of gas prices, megawatt hours, euros per megawatt hours, pounds, it's really not moved at anything like what we've seen in the past. So maybe gas prices and energy prices move up 1%, maybe 4% in April, maybe add 0.1 to inflation.
Yep.
This isn't something yet which is causing us to completely tear up the outlook. It's not of that order yet.
Do you think the risks are that we get that inflation is stickier than we think? The central distribution is, as you say, what you've laid out, but is the risk, which way is the risk on that?
So what have we learned over the past year? We've learned that inflation's been stickier than everyone hoped.
Yep.
You have to take something from that. But saying that, there are lots of reasons. When you look at the underlying gauges, as I mentioned, they are moving in the right direction. The big question really is what happens with pay? At the moment, people are expecting 4% pay gains. I'll be surprised if that's what materialises. But we'll see over the coming year. But if that will be the main problem if wage growth stays too high.
Jamie, great to catch up. Thank you for stopping by to update us. Jamie Rush, Chief European Economist for Bloomberg Economics. We've got a busy day coming up. 1:30 UK, you're going to see the CPI print out of the United States. We've got the CFO interview with Wells Fargo as well to catch up with as well. That conversation is going to be happening a little later on this evening, 8 p.m. UK time. Big US banks reporting day today. There's a lot going on. You want to stay tuned. The Pulse is up next. We've got a great lineup throughout the day. Enjoy the rest of the session, folks. This is Bloomberg.